Before we dive into the excitement of stocks, crypto, or whatever new trend is blowing up your feed, let me pause and give you a reality check. Investing isn't a game. It's a battlefield where your biggest threat isn't the market itself, investment, but your own decisions. I've seen too many people lose everything not because they picked the wrong stock, but because they ignored the warnings that were right in front of them. Today, I'm here to give you an important warning that could save you from becoming the next person who learns the hard way. If you take this message seriously, it could mean the difference between building lasting wealth and watching your money disappear overnight. Emotions are without question the greatest threat to every investor's success. It doesn't matter if you've studied the markets for years or if you're just starting out. When fear and greed take over, logic disappears and bad decisions follow. Let's think about this in real terms. Picture the investor who watches the market shoot upward, everyone bragging about their gains online, and suddenly they feel like they're missing out. That fear of being left behind drives them to buy at the peak investment without ever asking if the numbers make sense or if the company has real value. Then, just as quickly, the market turns, prices fall, and panic sets in. That same investor who rushed in because of greed now rushes out because of fear, locking in a loss that could have been avoided. This cycle repeats itself again and again, and it's the reason why so many people fail in the markets, not because the system is unfair, but because they let their emotions run the show. Right. The truth is, successful investing is boring compared to what most people imagine. It's not about riding every wave or chasing every hot tip. It's about patience, discipline, and keeping a cool head when everyone else is losing theirs. If you think about history, the biggest collapses in markets weren't just numbers on a chart. They were fueled by emotional extremes. The dot-com bubble, the housing crash of 2008, the cryptomanias, each one was a story of human behavior, investment, people believing things would only go up forever, or fearing things would never recover. In every case, those who let emotions control them ended up on the wrong side of history. Here's the part that's tricky. Emotions are natural. You can't get rid of them. Even the smartest investors feel that rush of excitement when a stock jumps 20% in a week, or that pit in the stomach when their portfolio drops in value overnight. Investment. The difference between losing and winning is how you act on those emotions. If you let the feelings dictate your moves, you'll always be buying high and selling low. But if you acknowledge the emotions and still stick to a plan, investment. That's when you start to separate yourself from the crowd. Think about it like this: markets are designed to test your patience. They're built to shake out the weak hands, the people who can't handle the ups and downs. That's why the average retail investor underperforms, forms the very index funds they invest in. They jump in when the news is positive and they sell out when headlines scream panic. If they had just held on through the noise, investment, the outcome would have been completely different. This isn't about being fearless. It's about being rational when it feels impossible. So how do you control emotions? The first step is having a clear plan before you put any money on the line. Decide your goals, your timeline, and your risk tolerance when you're calm, not when markets are moving wildly. Second, automate as much as you can. Dollar cost averaging forces you to invest consistently without second guessing every market swing. Third, remind yourself of the bigger picture. A single bad week or month doesn't destroy a portfolio investment, but one panicked decision absolutely can. In the end, investing rewards the patient, the disciplined, and the level-headed. The market doesn't care about your feelings. It moves with or without you. The choice is yours. Investment. Will you let fear and greed control your financial future, or will you take control and let logic lead the way? High returns always come with hidden risks, and that's one of the hardest lessons for investors to accept. The temptation of doubling your money overnight or jumping on the next guaranteed winner is powerful. But here's the reality: if an investment is promising sky-high returns with little to no downside, investment, that's your signal to step back and question everything. The market doesn't hand out free rewards. There is always risk, sometimes visible, sometimes buried so deep you won't notice it until it's too late. Think about all the bubbles we've seen over the last few decades. At the peak of the dot-com craze, people believed internet stocks would only go up because this time was different. Companies with no profits, no business models, investment, sometimes no real product, were trading at insane valuations. On the surface, it looked like easy money. People were becoming millionaires almost overnight. Investment. But the hidden risk was that most of those companies weren't worth anything close to what investors were paying. When reality hit, fortunes vanished in months. The same pattern repeated in the housing market crash of 2008. For years, home prices seemed unstoppable, and lenders told people there was no risk because real estate never goes down. That illusion collapsed, and the hidden risks became clear only after the damage was done. Fast forward to today, and the same psychology repeats in different forms. Whether it's meme stocks, speculative crypto tokens, or hot new startups, there's always a shiny investment promising massive upside. The pitch is always the same: Get in now before it's too late because everyone else is already making money. But here's the truth. If it sounds too good to be true, it usually is. That doesn't mean all risky investments are bad. Investment. It just means you need to understand what you're actually signing up for. Every high return carries with it the possibility of high loss. This is why due diligence is non-negotiable before putting money into any investment. Ask the tough questions. Where are the returns really coming from? What assumptions are being made about the future? What happens if those assumptions don't play out? If you can't find a clear answer, investment, you're not looking at an opportunity. You're looking at a gamble. There's a difference between investing and speculating, and the difference comes down to how much you understand and control the risks. Investment, the danger is that people often focus only on the upside. They calculate how much they'll make if the investment goes right, but ignore the question of how much they could lose if it goes wrong. Smart investors flip that thinking. They ask, investment. If everything falls apart, can I live with the downside? If the answer is no, it's not worth the risk. Protecting yourself from catastrophic loss matters far more than chasing outsized gains. Of course, there will always be those rare stories of someone striking it rich by taking a wild chance. Those stories make headlines and spread like wildfire, but for every one person who wins, there are thousands quietly losing money in the background. You don't hear about them, but they're the majority. Chasing returns without respecting the risks is how people end up broke. The safer path is balancing ambition with caution. Take calculated risks, but only with money you can afford to lose. Diversify so that one bad bet doesn't wipe out years of progress. And most importantly, remember that steady, consistent growth will always beat reckless gambling in the long run. The allure of high returns will always be there. But your job is to look past the shine, spot the hidden risks, and decide if the potential reward is truly worth it. Timing the market is one of the most dangerous games an investor can play, yet it's also the most tempting. The idea that you can perfectly predict when to buy at the lowest point and sell at the highest sounds like the ultimate strategy. But let's be honest, if anyone could do this consistently, they'd be the richest person on the planet, and the rest of us wouldn't even have a chance. The reality is that no one can reliably predict short-term market movements. Not analysts, not economists, not even the so-called experts on TV. Investment. The market is influenced by countless factors: global events, politics, interest rates, investor sentiment, technological changes, and most of them are unpredictable. Trying to outsmart all of that isn't investment, it's gambling dressed up in a suit. The real problem with timing the market is that it plays directly into our emotions. When prices are soaring, investment, people convince themselves they've missed the bottom and need to buy in now before it's too late. When prices crash, fear tells them it will only get worse, so they sell to avoid more pain. But history shows us that the biggest gains often come right after the biggest downturns. By pulling money out during tough times, most investors lock in losses and miss the recovery. It's a vicious cycle. Investment, it's why the average investor underperforms the market over time. Not because they picked the wrong index fund, but because they tried to time their entries and exits. Take the S&P 500 as an example. Over the last few decades, it's delivered solid long-term returns. But here's the catch: if you miss just a handful of the best performing days, your overall returns would drop dramatically. And those best days often happen during periods of high volatility, exactly when most people are sitting on the sidelines. In other words, by trying to avoid the pain, investors also avoid the gain. The irony is that doing nothing, staying invested, and sticking to a plan outperforms most of the frantic in and out trading that people think will make them rich. Another issue is that timing the market isn't just about being right once. You'd have to be right twice: first, when to sell, and second, when to buy back in. That's two perfect calls in a row. Miss either one, and you're worse off than if you had simply stayed the course. This is why even professional fund managers with teams of researchers and advanced models often fail to beat the market long term if they can't do it with billions of dollars in resources. What makes us think we can do it from our living room with a news app? The smarter approach is consistency. Dollar cost averaging, for example, removes the guesswork by investing a fixed amount regularly, regardless of market conditions. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this smooths out the volatility and takes advantage of the natural cycles of the market. It's not flashy, and it doesn't give you the thrill of calling the exact bottom, but it works. Long-term investing is about accepting that you'll never perfectly time things, and you don't need to. Wealth is built through patience, discipline, investment, and allowing compound growth to do its work. Chasing the illusion of perfect timing only distracts you from the simple strategies that actually build lasting success. So the next time you feel tempted to jump in or out based on a headline or a hunch, remember this: markets reward consistency, not clairvoyance. Protecting your capital is the foundation of successful investing. Yet it's the principle most people overlook in the pursuit of quick gains. The truth is, it doesn't matter how much money you make if you can't keep it. Far too often, investors chase after the next big winner and risk everything on a single stock or ignore diversification because they believe one opportunity will change their lives. But when that bet goes wrong, and eventually one will, it wipes out years of progress in a matter of days. Preserving your capital isn't about being overly cautious or avoiding all risks. It's about being strategic, disciplined, and understanding that protecting what you already have matters more than chasing what you don't. Investment. Think about this in terms of math. If your portfolio drops 50%, you don't need a 50% return to get back to even. You need 100%. That's the brutal reality of losses. Investment, they're much harder to recover from than they are to avoid in the first place. Every dollar you lose is a dollar that's no longer compounding for you. That's why professional investors focus heavily on risk management. They know that the road to long-term wealth isn't paved with lottery-style wins, but with steady growth and the ability to stay in the game no matter what the market throws their way. One of the simplest ways to protect capital is through diversification. No matter how confident you are in a single company, sector, or trend, putting all your money in one place exposes you to unnecessary risk. Even great businesses can stumble, industries can collapse, and unexpected events can change the landscape overnight. By spreading your investments across different asset classes, stocks, bonds, real estate, even cash, you reduce the chance that one mistake or one downturn destroys your financial future. Diversification won't eliminate losses, but it will make them manageable. Another key element is setting clear rules for yourself and sticking to them. Decide how much risk you're willing to take, how much of your portfolio you're comfortable putting into higher risk assets, and how much you want to keep in safer options. When markets swing wildly, those rules will act as guardrails, preventing you from making impulsive decisions that you'll regret later. It's not about predicting the future. It's about preparing for uncertainty. Emergency funds also play a crucial role in protecting capital. Many investors forget that having cash on hand isn't a waste, it's insurance. When life throws unexpected expenses your way, you won't be forced to sell investments at the worst possible time. Having that cushion allows you to ride out downturns instead of panicking. The peace of mind alone is worth it, investment, but the financial advantage is even greater. Finally, protecting capital requires humility. It's recognizing that you don't know everything and that no investment is a sure thing. It's resisting the urge to overextend yourself because of greed or confidence in your ability to beat the market. The investors who last aren't the ones who take reckless risks. They're the ones who build solid defenses, avoid catastrophic mistakes, and allow time to work in their favor. Wealth isn't built by swinging for the fences. It's built by avoiding the strikeouts that knock you out of the game. Investment. Protecting your capital ensures that no matter what happens in the market, you'll always have the resources to keep moving forward.